what is financing decision? Now, basically, financing decision is nothing but it is capital structure analysis. So, financing decision would mean how should I finance my business? It is a decision about the capital structure, as I just mentioned a little while ago, as to whether should I have debt in my business or I should have more equity in my business, and uh, what should be my capital structure. uh, Within the equity, how much should be my contribution so as to retain the control. So and depending on the inclination of the promoters of the business, ultimately capital structure decisions are the decisions which are taken by the owners of the company, because they will decide as to how much financial risk that they would like to absorb, and how much risk they would like to avoid, and that is your financial structure analysis. Now, how do you do financial structure analysis? What factors to consider in arriving at the capital structure? So we understand what is a capital structure. Capital structure is the combination of the capital that we bring into the business. So the capital structure in our business can comprise of equity capital, share premium, debt, retained profit, or it can also have preference share capital, it can have term loan, it can have debentures, it can have convertible instruments, and things like that. Now the question is, what factors, how should or how would promoters of a company will arrive at the decision about the capital structure? So the factors that they would take into account for arriving at the capital structure will include size of finance required for the project or for the business. So depending on the size, they would take a decision as to whether they would be able to fund the entire project through equity, or they would like to fund it in the combination of debt and equity. Number two, the second factor that would play a role in determining capital structure of a company is profitability of that project or of that business. Number three, availability of other sources of financing. Number four, cost of capital of different sources of financing. Number five, remember, equity is always expensive than debt. Equity is always expensive than debt. No doubt about it that on equity, the company or the management or the owners do not have an obligation to give any fixed return on an equity. But still, equity is more expensive than debt, because equity shareholders, since they take the risk, they will always have much higher expectation in terms of return. And what is the cost of equity? Please remember, and remember it forever. Cost of equity is very simple. And what is cost of equity? Cost of equity is the return expectation of owners of the company. That is the cost of equity. Or their opportunity cost is the cost of equity. And that is the factor number five that you will take into account in determining capital structure of a company. Debt provides flexibility in financing. That is what you need to remember. Existing status of debt equity ratio to be maintained. That is the decision that the promoters will take. Willingness of the lenders to lend further. Remember, given a choice, anyone and everyone will like to borrow as much as they can. But there are two restricting factors. And what those two restricting factors are? The first restricting factor is the ability of the business to service that debt. That means to be able to pay interest on that debt, and number one, also repay that debt. That is one limiting factor. And the second limiting factor is the willingness of the lender to give you a loan. So if your balance sheet is not very good, if your profitability is not very good, that does not really matter as to how good a person you are, nobody will lend you money. So the another factor is willingness of the lenders to lend further. Willingness of the market to chip in with equity. So many times, a lot of companies come out with public issue, and nowadays it has become fashion that the companies that come out with public issue, they charge any amount of premium that comes to their mind. In the process, what happens? Since the market is in a good condition, a lot of people subscribe for the public issue, paying a very huge premium for these shares. And these shares, within a span of few weeks or months, nosedive. And the example in front of every one of us is that of Paytm. Paytm ka public issue was at a price of 2,150, and within few months, within a few days or within a week, it nosedived by almost about 40%. And today, currently, it is ruling at one third of the issue price. But still, willingness of the market to chip in with equity is another factor that has to be taken into account while determining the capital structure of a company. Availability of funds with the promoters. So promoters may be wanting to invest a lot of money into the business that they have started, but they must have the money. If they do not have the money, then they have no choice but to go for other investors or other lenders. And finally, of course, desire for control by the promoters. Another very important factor that determines the capital structure of any company, and that is the desire of the promoters to retain the control of the business in their hands. And thereby, promoters of all the companies will always like to have major part of the equity with them, so that they are able to run the business in the way in which they want to run. So friends, these are the factors that will determine capital structure of any business, and very important decision for any business. So in case if you have any question on this, you can please ask me, else we can go to the next topic.